Welcome to Taking Stock for the week ending the 11th of November 2022. I'm Trinh, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share market. But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any charts and tables presented shouldn't be relied as a guide for future performance. Welcome back, Jace. I hope you're doing well and also hope that you haven't invested in Bitcoin over the last few months.
No, there's definitely not many campers in that space right now, Kien.
Well, volatility is still the name of the game, and this week there has been a huge market reaction to news that the annual inflation rate in the US has slowed to 7.7% last month, and that's the slowest rate since January, with investors now hoping that the Federal Reserve will ease the pace of interest rate rises over there. And of course, with volatility comes Bitcoin as well. They continue to hit the headlines after the crypto exchange FTX.com looks like they're facing bankruptcy unless they receive a cash injection of around 8 billion after its competitor Binance decided to back out of a deal to acquire the business. So FTX has been a prominent cryptocurrency exchange, and they've been supported by high-profile partnerships with athletes and sports teams. And it was actually valued at 32 billion in January this year, but now it's on the brink of collapse.
Well, I guess this actually highlights the importance of investing and dealing with financially healthy businesses. Corporate insolvencies are on the rise, but not just here, but all across the world as well. This is why it's important to invest in the numbers, companies that have manageable debt levels, strong cash flow, profit margins, and earnings quality, which should help cushion the impact of rising interest rates and inflationary cost pressures.
That's right, Jason. Speaking about inflationary cost pressures, especially with regards to labor and materials, one sector of the market that is susceptible to rising interest rates is the housing and construction sector. And we can see the trend in construction activity with the chart on screen, which has dropped dramatically from its peak in late 2021. As a result, we are closely reviewing some of our star stocks in this sector, borderline star growth stock, CSR, and we've had to remove our coverage of James Hardie as well. Now, recent updates by both companies suggest CSR is in a better position, mainly because it does not have exposure to the US, where there's been aggressive interest rate increases. Now, Australia is still benefiting from a large backlog of construction projects, with the industry supported by also the federal government's home builder scheme as well. But we'll speak more on this later in the episode.
And also, with bank reporting season now over, a few key themes have emerged over the past couple of weeks. For example, rising interest rates have helped banks increase their net interest margins, which is the difference between their lending rates and the rates that they pay in deposits. Meanwhile, rising interest rates have had little impact on bad debts and home loan growth. Costs, on the other hand, have risen by more than expected, especially in regards to wages, although investment in technology over the years have helped reduce this impact. And finally, management have become more cautious around the outlook, alluding to increasing competition as borrowers try to refinance at cheaper rates. Also, home lending growth is expected to fall from 7% to 2.5% in 2023, while bad debts could increase. In fact, the banks are expecting cash rates to peak at 3.6% in early 2023, suggesting 3 more rate rises, Kien, of 25 basis points each.
Yeah, but the earnings have been quite resilient. In fact, there have been positive revisions for the banks over the last couple of weeks. And these themes were quite prevalent across Westpac and NAB's result over the week. But Westpac, it was interesting. Westpac was sold down by about 4% on its result. And that was due to rising cost pressures and also strong competition in the mortgage market, which led to a slower than expected rise in its net interest margins in the second half. But despite this, with a payout ratio at between around 65 to 70% and positive earnings revisions, we do believe that dividends on both Westpac and NAB are sustainable, with both banks trading on attractive gross dividend yields of about 8%. But more on this in question of the week later as well. Now, while interest rate increases have been a tailwind for the banks, The pace of the recent lifts has started to impact the housing market, especially residential listing volumes. And online residential platform and star growth stock REA Group, they did note an 18% decline in national listings over October. Furthermore, you have inflationary pressures, especially on wages. They are likely to impact their margins as well. So how confident, Jace, are we in the earnings for REA? Can they grow by about 7% over financial year 23 as indicated by consensus?
Well, there are a couple of growth levers, Kien, that management can pull, which could cushion the impact of the slowing residential activity. For example, they have pushed through a number of price increases, and this has supported revenue growth. And they've also introduced new service categories. In fact, over the first quarter of 23, we saw an increase in the take-up of premier listings as more and more sellers and agents try to differentiate themselves in a challenging sales environment. In addition, their expansion into emerging markets such as India, Brazil, and other Asian countries should help mitigate some of that earnings volatility. These initiatives can also help sustain the single-digit growth forecast in FY23.
Yeah, let's hope so. Quite challenging conditions for REA Group at the moment. But another stock within this sector is borderline star growth stock and star income stock, Nine Entertainment. The company was forced to revise its first half earnings to be at the lower end of their guidance range, and that's due to the softening housing market, which impacted the listing volumes on Domain. So no surprise there. Remember, Domain contributes about 13% to their total revenue. Positively, though, the company does expect to outperform on advertising revenue on the back of higher subscription growth, which now accounts for about 32% of their total revenue.
However, earnings guidance could weigh on forecast ROE, which is currently at 15.9%. And this suggests the stock could potentially fail Lincoln's growth criteria when it reports in February 2023. From an income perspective, however, the significant margin in free cash flow, which is way above dividend payments of 23 cents per share compared to dividends of 13.8, should help the stock maintain an above market yield of around 10%. In fact, they have so much cash that they recently announced a share buyback of up to 10% of its stock, Kien.
Wow, and even though the sector is facing headwinds, the great thing about Nine Entertainment, though, is that it is diversifying its revenue towards recurring subscription models and away from those traditional advertising sources like TV, newspapers, and radio, which tends to be more sensitive to the economic conditions.
Sure are, Kien. All right, so moving on to the corporate calendar. Now we've got star growth stock and gaming company Aristocrat Leisure expected to report its annual results on the 16th of November. In terms of dividends, we've got NAB and Westpac expected to go ex-div on the 15th and the 17th respectively. And also continuing on with the AGM season, we've got some interesting names expected to provide updates next week, including Gemworth, Altium, and Lovisa.
And in Under the Microscope this week, we take a look at building materials company and ex-star growth stock, James Hardie. The company specializes in fiber cement products and has around 76% earnings exposure to the US. But not only was its first half result below market expectations, but they also downgraded full year earnings guidance. So, Jace, what was the reason for this downgrade?
Well, Ken, it was actually pretty disappointing considering the fact that management downgraded their guidance by 4% in the first quarter, and only this week they downgraded again by another 10%. The downgrade was driven by continued poor trading in Europe, which saw profit margins half to 7% from the previous 13%, and this is on the back of rising gas and raw material prices, which have started to erode earnings. Furthermore, there was a slowdown in sales across the US, and this is caused by a material slowdown in the residential building and construction industries as interest rates begin to rise.
Yeah, a disappointing update, Jace, indeed, but we did articulate these risks in our active risk section. And also earnings quality is now weak on the back of deteriorating cash flows from rising inventory and expenses. But we've been quite vocal about those active risks in our past commentaries. So why didn't we remove the stock earlier?
Well, unfortunately, Kim, we didn't have enough visibility around their earnings. The company has very strong growth metrics with an ROE of 47% and net profit margins of above 17%. Given the strong market position, the company was able to offset these risks by implementing strategic price increases and also marketing directly to homeowners and renovators. However, this was not enough to offset the challenging market dynamics, including product order cancellations and also significant reductions in the FY23 pipeline.
Yes, but for many investors out there and under Golden Rule 5, they would have noticed that the stock is now trading at roughly a 30% discount to valuation. So is this an opportunity for investors then?
Well, valuations are still very subjective, so we should not put too much emphasis on the consensus price target at this stage, given the fact it could move lower over the coming weeks. Those who are trend sensitive should sit on the sidelines because the stock has triggered an exit on the SD30 TSR. Following this earnings downgrade, the weak earnings quality and also rising interest rates and inflationary cost pressures are expected to continue to impact the construction and housing industry in the US. We have decided to remove the stock from coverage as a result. Although earnings expectations have been revised down by 9%, we believe the forecast ROE of 48% remains a little bit too optimistic in the face of these challenging market conditions.
Yeah, well said, Jace. But also just note as well, the company has experienced a change of management. And although the CEO, Aaron Erter, has significant experience in manufacturing industries, he still needs to really prove himself in sailing this company through choppy seas. But we will reassess this business in 6 months' time once the financials flow through. And with the conclusion of the bank reporting season, Jace, the key question this week is, how did the 4 major banks perform?
Well, from a high-level perspective, Kien, both Commonwealth Bank and Westpac, 2 of Australia's largest banks by market share through their sizable loan book, have performed quite well. The bank CBA trades on a lower dividend yield than the other banks due to its strong market share in loans and customer deposits, and this has allowed the bank access to cheaper funding costs and helping it sustain a higher net interest margin. Westpac is expected to go ex-dividend on the 17th of November, but the business has been weighed down by higher than expected cost inflation, and also this has put pressure on net interest margins as it focuses on market share growth. Comparatively speaking, ANZ and NAB have a larger chunk of their loan book exposed towards the business and institutional lending segments, and this segment is expected to grow ahead of mortgages over the coming year. Although ANZ appears to be on a more attractive dividend yield at 9%, this is partly to account for the execution risks relating to the potential acquisition of Suncorp's banking division, and that's expected to close in the second half of 2023. NAB is expected to go ex-dividend early next week and trades on an attractive gross dividend yield of just under 8%.
Yes, Jace, these yields are quite attractive, but on the whole as well, we believe those dividend yields are quite sustainable for now. This is on the back of rising earnings expectations, an unstretched payout ratio, increasing net interest margins, and also lower bad debt expenses. And to help you decide though, you can compare the banks by building a new filter under the Stock Doctor filter tool. Select banks under the GICS classification and then include the following fields: forecast return on equity, gross dividend yield, forecast payout ratio, the days to ex-dividend date, 3-month earnings revisions, and also, of course, 1-year total return. That's all we have time for today, but thanks, Jace, again for your contributions.
Thanks for having me, Kien.
And also, just a reminder, we do have the Lincoln Live session on Monday, where our team of experts, including our Chief Investment Officer, Tim Lincoln, will be there to help answer your questions on stocks and the market. And to summarize this episode, well, volatility does create opportunity, but focus on financially healthy businesses as economic conditions wind down. But before making an investment, make sure you read and understand the heightened active risks, such as those in the construction industry. And of course, bank dividends, they look sustainable in the current market environment. Have a happy, healthy, and prosperous week, everyone.